Broadly, we are going to discuss bond, equity, dividend policy, leasing, and cost of capital. Before I discuss all this, let me give you the idea what we are going to discuss today. Suppose you are a listed company and you want to get money for the new projects or for your running of day-to-day activities. What options you have with you in terms of money? The traditional way is you go to the bank. Bank will give you, they will take your financial, they will assess you where you stand, that much money they will give you. But you can see in this way also that banks as a procedure, what they do is they take money from the public and give it to the public. It's like a platform for which matches the borrowers and the lenders' need. So if you want to give money to the bank, they will offer you 4%, 5%. You want to take money from the bank, they will offer you 10%, 11%, 12%. So it apparently gives, why to give this benefit of 6% to the bank? Why don't you go to the public direct? This leads to a concept called equity financing. Equity is the owner money, the share capital that you have, and sell your ownership, get the money from the public directly. If bank is giving them 4%, 5%, you give them 7%, 8%, more than the banks, and avoid a cost for you. Don't go in the fixed liability situation, go in the equity portion, sell your ownership, get the money out of it. And at the end of the year when you get the profit, if you get the profit, give them dividend. If you don't get the profit, no need to give the dividend. This seems more easier in comparison with going to the bank. Either you have sales or not, either your company is going well or not. Fixed liability is there, you have to pay the installments every time. So that arises the need of issuing the equity. The other way is, you don't want to sell your ownership. You are a big company, you are the shareholder, you are the director, you are running this company 60 years, your family 100 years. So you don't want to sell your ownership. Now what to take, how to take the money? Then same like bank, you take debt financing. Debt financing is you don't sell your equity based on your asset or based on your infrastructure, you issue the long-term bonds. Bond is a contractual agreement to pay a fixed agreed interest rate on a fixed period of time. This is how you again go to the public directly with creating liabilities on your part. So broadly, corporations take loans or get money from the public by two ways. One is equity financing by selling the ownership. It has its own advantages, disadvantages. The other way is equity financing. Equity financing debt financing is when you go to the public and you create liabilities on your part. Bank loans also come in debt financing. So today we are going to discuss what are the bonds, equity, dividend policies. Mortgage bonds are backed by the specific asset that you just discussed, Leam. Anything that is backed by specific asset, it may be a stock, it may be a commodity, it may be anything. Or debentures are backed by the borrower's general credit but not by the specific collaterals. You are a company called Nestle, people trust you, you are a big company. Nestle issue bonds to the public, people will invest because they enjoy the credibility. But in fact, nothing is on the back if they default or they are in losses. So, and they close their operations, so this asset they sell and give it to you. Type of bonds, we can see the ownership. Registered bonds are in which the bond is issued. Bearer is the person is like a check, bearer checks that the person who carries the bond is the owner of the bond. So we have two types, registered bonds and we have bearer bonds. Priorities. Subordinated debentures and second mortgage bonds are junior security which claim inferior to those of the senior bonds. What is second mortgage? We have first mortgage. We have, suppose this is gold, I give it to someone, this is first mortgage, he has as a security. Now the same I did mortgage again, that is second mortgage. So you can see this is the mortgage thing, you again mortgage, so it loses its credibility in a sense that you are less secured now. Then we have repayment provisions, income bond pay interest contingent on the issuer's profitability. Revenue bonds are issued by the governmental units and payable from specific revenue sources. Now, for any investment in a company, first of all, you should see the rating of the company. There are certain companies like Moody and the Fitch and the Standard and Poor's. They give you independent evaluation of the companies. Generally, the four big companies, they have AAA category. For AAA category, if company is falling, so no worries, you can invest in the company, no fees at your part. But always keep in mind the rule of thumb, that is higher the risk, higher the return. The more secured your investment go for, the least return you get out of it. That's why people invest in foreign currency, in money markets, in stock markets, because we don't know the risk is higher and the return is also higher in terms of loss or in terms of profit. Then he says investment grade bonds are considered safe investment and thus have a lowest yield, that is AAA. Non-investment grade bonds, also called speculative grades. These are high yield bonds, junk bonds, carry high risk. They exploit the tax deductibility of their large interest payments. They are often used to finance leverage, buyout and mergers. This is actually, if something is secured by a high rating company, this is a secured investment. Otherwise it will be a speculative investment, means more risky. This is least risky, this is most risky. Now there are some rates which we discuss with the investments. That is, one is the hurdle rate, one is the investor expected rate of return. This is so. He says using the effective rate to determine the bond present value ensure that upon maturity they will be valued at their face value. This is one unit for investment appraisal in which we will see capital budgeting. That is our next lecture. We will see the time value of money. Suppose if you are going to invest something for 10 years. So today we have to know what is the future value of this investment and what is the present value of that value. So we can see this is the time value of the money concept, which we calculate the net present value and by using the discount tables and statistician and develop this model that if dollar today in this year, in year 0 is 1, and in year 1 it's 0.98, in year 2 this is 0.96, reducing its value with the time. So he is saying that using the effective rate to determine the bond present value. So we should know what is the maturity value as well. When the bonds are traded amongst investors in the secondary market, the issuer is not the party to the transaction and receive no infusion of cash. Actually, there are two types of market. One is primary market and one is secondary market. Any IPO, that is initial public offering, always done in the primary markets. Then When you go to the stock exchange, already listed stocks are there, you start buying and selling. This is how the mechanism of the market goes. The amount that changes hands between the old and new bond holder is determined by a risk assessment and the interest rate prevailing in the market at the time of the trade. What is the economic structure, what is the interest rate, what is the inflation level, how the market is moving, these are all the symptoms we have to keep in mind for calculating the future and present values of the bonds, maturities and terms. Then you can see a graph, you can see the interest rates going up with the time to maturity. As you increase the time of maturity, it will go up, slightly up, and one point it will become down. It will start becoming stable and later it will come down. So when the interest rates on long-term debts fall below that of the short-term debts, it is generally taken as a sign that the economy is headed into recessions. So it becomes opposite. Means as the interest rates will increase, the maturity date will decrease, reduce. So those who are familiar with economics, they might see this is a demand curve, which has an inverse relation between this and this. As this goes up, this goes down. The first one was like a supply curve, which has direct relation between as the interest rates will go up. Means if we are confident about the country, economy, market structure, so if an investor will come, he will say if you invest 3 years, we'll give you 8%. If you invest for 4 years, we will give you 9%. So there's a direct relation between as you increase the maturity, interest rate will also increase. Because market is in confidence, people are taking positive. But if it is a recession, no one is going to take the risk of time to increase the maturity, right? So they have to come in other way. Said they have to offer high interest for the low period products, right? Now we will discuss the equity. Equity, another way is shareholding, stock holdings, is the owner money which we called as equity. Equity is of two types majorly. One is the common stock, one is preference stock. Common stock is a stock which has no fixed dividends. Company has no commitment for any return, but they have a voting right. So they can come in the meetings of the company and they can select their directors. This director will make a board of directors who will run the strategic vision and strategic approach of the company they will develop. They will appoint a CEO who will run the company and he will report to him. Then we have an audit committee who is ensuring things are going on. This is a corporate structure. So we have to see that this is a mode of financing for us because we can sell equity, we can get money out of it. If you are a high risk seeker, you will always go for a common stock because common stock is not backed by any security. It is always going on the credibility of the company. You are satisfied that, for example, RBS Bank is the best bank, or you are going to buy the share. There is nothing on the back which is securing yourself in case of liquidation. You are the last one to get the money. Based on that is preference stock. Preference stock is a type of shareholders which has the fixed dividend the day one you sell the stock. 5% in, 3%, 7%, anything. But you have a fixed commitment. You have to give them dividend if at the end of the year. So it's sort of hybrid between debt financing and equity financing. Some people assume this is not a sort of genuine sort of equity because it has fixed interest. What kind of equity this is? This is a liability in accounting terms. So the common shareholders are, but they don't have the voting rights. The preference shareholder has no voting right, So they cannot elect anyone in the board, or they cannot form anything as a firm. They are secured. These the common stock are not secured. They have high risk, high return. They have secured risk, secured return. Common stockholders are the owner of the corporation, and their right and owner, although reasonably uniform, depend upon the law of the state in which the firm is incorporated. Equity ownership involves risk because holder of the common stock is not guaranteed a return. And last in the priority in a liquidation. What is the advantages of the issuer? Common stock does not require a fixed dividend, so there is no profit, there is no dividend, simple. There is no fixed maturity date because it is subject to profit. Unlike bonds has nothing to do with the profit. You have to follow your terms and conditions because it's a contractual obligation. Equity is subject to the profit. If you have profit, you will give the dividends, otherwise no dividend.